Welcome everybody. Today's short video is on key factors to help you choose which position to trade when multiple positions are potentially presenting. That could be consistent with your trading plan criteria. It's a little bit of a quandary for sure, but let's try and unpick that with three key things that may help your decision making. So let's start with an overview, really. It's not unusual, as I said, to come across multiple opportunities when scanning the market. The key challenge, therefore, for you guys is when faced with such a choice, is how do I make the decision which is the best fit for me and my trading plan? So, as I said, there are some guidelines I'm going to give you today, which you can take or leave, but may help you in terms of making such decisions. There are two choices you have essentially, either to make efforts to develop a system that can assist in your decision making. You can subsequently test that. The alternative, of course, is to not have a system at all and use the force or some other supernatural power and have an ad hoc approach to making a decision. I'm pretty sure you know which is the best choice to make. I'm going to start with some assumptions, including that any opportunity is consistent with your trading plan criteria, as you've already intimated. Not only technically, but also is it within your trading competence, i.e., it's a strategy that you're aware of and meets other criteria that you may have in existence, such as maximum number of positions you're prepared to have open at any time, and of course, the use margin. So let's get into those three things. The first one is strength of signal, because not all signals are created equal. There are sometimes a clear indication of a tick box rather than just scraping over the line. You could take, for example, a move through resistance. Quite often, what we'll do is we'll suggest people put a spacer, an ATR spacer, in between that key level, perhaps a half an ATR up. So if it was an FX trade and ATR was 20, you might put it 10 pips to the upside to make sure that it's closed in a territory which suggests that that breakout is happening. And, and obviously, the common sense, it could be that it is that you use a bar close rather than any sort of just intra-bar move over a resistance line. Of course, that principle is transferable to all sorts of criteria that you may be using. So volume, price, and candle close are all three things you can have a look at. Clearly, if you've got two candles, one that's closed in the top half and one that's closed in the bottom half, and you're looking for a long trade, then the former is a stronger signal that things may be more likely to move in your desired direction. Just be aware that when you're looking at this, there may be an overcooking of some indicators or one specific candle, so you may see spikes on volume. Often you'll see those very long candles subsequent to data releases or sometimes at the beginning of sessions. Those are really ripe for short-term profit taking by some traders. So it may be that you specify within your trading plan a maximum trade level, or maybe if it's over three times normal volume, then there's something interesting going on, which just may either make you a little more cautious to enter at all, or may suggest you enter at a smaller volume that is your norm. Number two is the move potential. This is obvious, though it may be that you're not actually looking at this when you look at a chart. So let me give you an example. So if you have two charts, one where the next resistance after a breakout is 50 points to the upside, the other which is 15 points to the upside, which one is going to be more attractive to traders? Not surprisingly, the latter is probably the case. So that proximity of the next key level could be something that you include in your plan. Again, you can use an ATR multiple perhaps, or something of that ilk, or simply in a number of pips or points if you're trading indices. So the more attractive the upside potentially is, the more traders it's going to attract. That increase in attraction of traders is going to increase momentum, which ultimately, of course, may help price move in your direction. On top of that, new signal on multiple timeframes may attract traders from multiple approaches. So if you've got a chart which is showing a buy on a 15, a 30, and an hourly chart, you're going to get buyers from all of those who trade those primary timeframes rather than just it being on the 15-minute chart, for example. There's that example I gave of the 1% versus 3% move, and the liquidity of the asset might be important. So the more traders that are interested in a particular asset, the more likely that that interest that's increased will attract more buyer selling pressure. So, for example, if you're Choose an extreme one if you're testing the difference between a Euro USD to a Euro Polish Zloty, then there's more traders going to be looking at that USD. That increased liquidity is going to help with that momentum and push it higher. So number two is move potential. Your third is the state of the underlying trend. Now, I have referenced trend within the strength of signal as potentially a key factor in decision making. We know that on any time frame, a longer term time frame is indicative of a more likely move to the upside. So, for example, if you are looking at a 30-minute chart and you're seeing a trend continuation, that trend continuation may just be a retracement if you look at a longer term chart. So, for example, a 4 hour. So, it's always worth having at least one chart which is of a higher time frame just to tick it off that that's the case. So if you were to systemize this or write in your trading plan, you would actually specify if I'm looking at a 30 chart or an hourly chart, we're looking at a 4 hourly. If I'm looking at a 4 hourly, I'm going to look at a daily. If I'm looking at a daily, I'm going to look at a weekly. So you would actually specify quite categorically. Remember, any trading plan statement that you have is supposed to be specific and unambiguous. So make that part of your criteria. So those are your three things that could enable you to make a decision on which position. Of course, and remember that often you'll get very correlated assets. So even if you choose to use two or three, just keep an eye on how many positions you've got in one sector if trading share CFDs or one currency if you're trading FX, as an example. So it may also, as well as specifying maximum trades in your trading plan, you may say, I'm not going to enter more than 2 or 3 positions with any one currency. There you go. I hope that's useful, interesting, give you some things to look at. So, in terms of actions you can take, review the 3 questions we've covered, decide which of these could be relevant to you, which resonate. Is it 1, is it 2, or is it all 3? And of course, integrate these within your system with appropriate parameters to allow you to action these and test these in the reality of your own trading. I hope that's been interesting. Trade safe and see you again soon. Bye bye for now.